So thank you very much, Susanne. So I would like to talk a couple of minutes on a topic that Hilde introduced in the morning. That's the founding of insurers. So you said all companies present here have been founded some time ago, 50 or 100 years. We haven't seen too much development in that area the last 10 or 20 years. So the question now, and it has been posed by a couple of speakers here, things are moving, and the question is valid: do we expect a new founding wave of insurers? And could the share economy be the breeding cell or the start of the founding of new insurers? And I would like to get a little bit into history. Why have the current forms of insurance been founded? And so I start with the PLCs, the listed companies. Well, that story is well known. How would a PLC be founded? Somebody has an idea of a business model, of a business case. And well, today we don't earn money on a risk-adjusted basis on the asset side, so forget that. You have an idea on having a combined ratio of perhaps 95%. This translates somehow into 10% return on equity. And you say, go to someone and say, I can offer 8% return on equity. I get 2% for the idea. The 8% is yours. And so the story begins. So the focus is on return on equity. And I have been with a PLC, and you turn a lot on return on equity. This doesn't mean that the product is inferior or so. You all are consumer-oriented. All of these companies are consumer-oriented, otherwise they wouldn't exist anymore. So, but the focus is on return on equity. Then I had a look in public law, or better, public ownership insurance. Germany has a quite strong sector. It makes about 30% of market share of public-owned insurance. And there was a big campaign from one of the companies, and we have been founded by the king, and that's a good thing. I started to consider, what? A king? Well, we know about giving theaters to the public, but an insurance company. Then I did a little bit more research, and then I came the next told of we were founded by the Duke. Next, we were founded by the prince. That's even weirder. The prince is not in charge usually. Why would the prince found an insurance company? The story then was easy. In former times, when something bad happened, the city burned down or so, the people went to the king or the prince who was delegated that task and was begging for money. And so the idea is natural. Let's found an insurance company. You get some premium up front. It's better to pay you have to pay the money anyway. Make insurance is a good model. So they are still strong. There are no kings, there are no princes, but they are focused on the regional market. They have worked themselves very strong into the public opinion, and so built up a reputation that at least in Germany still works, and they have also growth rates. So mutuals, I do not need to tell a lot on mutuals here. The focus is on product. And then comes the new thing, the peer-to-peer idea. And we have seen from Cohen a definition. I try to distinguish it. The peer-to-peer thing is the mutual benefit for small, overseeable groups. The mutuals, as we are today, are mutual benefit for large groups. We have 3 million members and 10 million insureds as a company, so that's a very big, large group. But the mutual benefit still remains and is the focus of the company. So I would now address you to imagine what would happen if we would get the idea to found an insurance company. Maybe we have a gala dinner tonight and get in the mood and say, let's found an insurance company. So now I would provide you with a couple of aspects to discuss. And the first thing, the advantages would clearly be we have a better risk profile. Why is that? We work in the insurance company. There is a proposition that people working in the insurance company are risk adverse, so they could have a better risk profile. I have to moderate that a little bit because I'm working for a motor company. Motor company, people that work there love cars, fast cars, but also safer cars. So we have better known needs of the insured. We have the chance to tailor the product to our needs. It's an overseeable group here. We meet here. We have reduced moral hazard because if there's somebody faking claims, we would all point the finger on him or her and say, oh, that's a bad behavior. So moral hazard is expected to be reduced. And we have increased risk awareness and lower losses. This is the proposition that we have. Well, I also thought on the challenges. And when I prepared this, I remembered that some of my former colleagues, they actually were engaged in founding an insurance company on a mutual basis. And I talked to them. First thing I learned is that much more going on than you usually hear. The reason is clear. People like to talk of success more than on failures. So if you have a success, well, that's well known. If you have a failure, you have bad memories, you have possibly lawsuits ongoing, and you do not want to be reminded, and you do not want to get your fit and proper view in the wrong direction, so you don't talk about that. And I thought in the beginning that the minimum capital requirements would be the most inhibiting thing. But it turned out that's not the case. If you don't have an investor, somebody who provides money up front, you do not even start. So in all these cases, it's 3 cases I know of, the capital was not the problem. The prudential regulation requirements, well, that's another story. In founding a company, it's not the main topic, you can handle that, but you have to think when you grow, and when you grow into the Solvency II area, you get into, at the point of time, you have to implement Solvency II. You have a high cost burden all of a sudden, and you can discuss proportionality, yes or no, we have had this topic. This has prevented, in one case, the founding of a company, because they said, we think we have a business case growing in 3 or 4 years' time into that area, but then what happens then? So, but the main killer in the cases was the protection against high impact, low probability loss. One of the cases in Germany was a case of the midwives, that where the liability costs for midwives were going up very high. The midwives, these are the people, the women that help others giving birth. And the liabilities went up, claims went up, and so they did not get insurance anymore. So they said, let's come together, found an insurance, and they soon found out that the problem is not the regular insurance, it is the reinsurance thing, because they could not cover a serious loss in that area. So then operational stability is a topic. You have to provide a lot of administration. One other killer was intra-group governance. In one case, it was founded by people on a purely idealistic basis. And they got together with people providing services. And there was a misunderstanding whether the service would come free of compensation or with compensation. And in a short time, they were in disagreement, and it broke. Let's say the internal governance broke down. So the conclusion: if you want to set up a peer-to-peer risk community, there are models on the marketplace, usually with a high upfront premium. One insight: you need to capture the money upfront. It doesn't work if you have a claim and go to the people and say, no, please pay 500 euros. So usually it comes with a high no claims bonus, but you need a partner. You need a second layer. It can be a classic insurer, captive, or reinsurance to have out-of-community protection for big losses. And I agree with Mathieu that you need to look on that area with this other partner. Could also be Google, Facebook, etc., etc. And probably our industry would not like to have it that way. So, yeah, that's my statement. You need a two-layer environment.
Thank you. You can stay. You, Frank, also have a question to the audience. And
yes.
That is, would you feel comfortable to share your insurance risk at mutual basis with the people in this room, subscribing to a maximum net contribution of €600 per year? So what do you think about that? Would you like to do it? Yes or no, or yes, but a lower amount. What do you think, Frank? Do you think they will want it? No. We'll see. Oh, yes! What's the reflection? Yeah. What do you think about it?
I thought about taking €6,000, and I think the answer would have been different.
Yes, it would. Probably would. No, thank you. We were a little short of time. As you know, we started almost half an hour late, but now it's 5:30. But I thought maybe we can take time for one question. Is that okay, Hilda? If I can have one question from the audience. Do anyone wonder anything about these subjects, or do you just want to go home to have dinner? No questions? Okay, I'll have to ask you one question then, because we talked about this about lunch. And we're talking a lot about sharing economy, and the mutuals are in a way. Do you think in this panel that we should connect to the sharing economy and get involved as mutual company? Very short answer from you all. We start with you, Cohen.
Well, if you think about car sharing, peer-to-peer car sharing, the insurance case is very hard because there's a lot of misuse of insurances. Because if I have an accident, I don't tell, I rent it out the next day and have a micro-insurance, and then we do as if it happened the day after. So insurance companies are struggling. So it looks like a big market, but the business case for insurance is not clear yet. Having said that, as was stressed, the insurance models based already on trust and communities would fit normally better with sharing practices than the more profit-oriented ones. But I agree with all speakers. You will have to look at it. It will not be easy, and no one has the answers right now.
Mm-hmm. Thank you. Matteo?
I think following the argument Kuhn just made, it's the pressure on us will be increasing, and probably very quickly. So it will be difficult maybe to make insurance coverage for Airbnb, but Airbnb will cut out the purchase of cars themselves, so the market will change. So for me, yes, we are in a position with a lot of advantages. A limited company, insurance company, hasn't got the what I call chromosome genetics that we have. Sharing economy is mutual, so let's leverage on this. That's my...
Arnold?
Yeah, as I said, we should follow, we should monitor closely the trends in our societies. So as the sharing economy is emerging, we have to monitor, we have to try to connect, to understand the model, to keep our agility, and then we'll see.
Okay. Matthew?
Yeah, maybe I'll ask a question due to the fact that I don't understand everything I read. But there was an infographic outside. I work a lot with infographics. And it was interesting because, if I understand well, your companies have a 12% share of the insurance market in Europe. But yet there is 230 million people that you insure. And so it's interesting because if you look at the totality of the citizens in Europe, I mean, it's a big number for a small share of the market. So here... 25% market share. 25, okay. But 25 still small compared to the huge number of citizens that you insure. And so here there is a community and there is a potentially to see how this community could be used to help you. You help them. This is, I think, the new way to enter this market. Not top-down anymore. This is to the bin. Now it's bottom-up. You know, this is how you're going to find new way. And your community is big. It's there. And as has been said before, they love the value that you are communicating. So this is a huge asset in these times.
Okay, Frank, your final comment for today?
Yeah, I would say that all of the forms of insurance, the mutuals are closest to the share economy. Mutuals and share economy is not the same, but the mutuals, they would have the best preconditions to understand what the share economy is about. So I think this is a very good topic at that day.
Thank you. So that was all for today. Thank you very much, and thank you, panel.
Thank you.
Thank you.